2018, unchanged from the previous forecast. It will move to 5.2% in 2019, down from 5.4%, and 5.1% in 2020. A peak of 5.5% is expected by the first quarter of 2019 before the value-added tax increase falls out of the data. The forecast for core inflation is unchanged at 4.6% for 2018 and is 0.2 percentage points lower at 4.9% for 2019. It is expected to remain unchanged at 4.9% in 2020. The main changes in the forecast related to the value-added tax increase and the exchange rate. The VAT increase is expected to add about 0.6 percentage points to the headline inflation trajectory for the 4 quarters from the second quarter of 2018, with marginal second-round effects persisting into the subsequent quarters. The improved exchange rate has softened the impact of the indirect tax adjustments on the inflation forecast. The implied starting point for the rand is 11 rands 97 cents against the US dollar, compared with 12 rands 90 at the time of the previous meeting. Inflation expectations, as reflected in the survey conducted by the Bureau for Economic Research in the first quarter of 2018, are at a multi-year low, having declined across all groups of respondents. Average expectations for 2018 and 2019 have declined to 5.2% and 5.3% from 5.7% and 5.9% previously, while an average of 5.4% is expected in 2020. The largest adjustment was seen in the business category, with downward revisions of around 1 percentage point in both 2018 and 2019. 5-year inflation expectations declined to 5.3%, their lowest level since they were first surveyed in 2011. Expectations implicit in the break-even inflation rate, that is the yield differential between conventional bonds and inflation-linked government bonds, declined across all maturities. While these developments are welcome, the MPC would prefer to see inflation expectations anchored closer to the midpoint of the target band. The global economic outlook has remained favorable amid a relatively synchronized upswing in the advanced economies, although risk and vulnerabilities remain. The global inflation outlook remains benign, but on a moderate upward path. However, the recent trade policy actions by the US could escalate into a trade war, which could undermine this positive prognosis for growth and push inflation higher. The rand has sustained its recent gains since late last year, and some of the key risks to the outlook have dissipated. Since the previous meeting of the MPC, the rand has appreciated by 4.8% against the US dollar, by 3.2% against the euro, and by 3.5% on a trade-weighted basis. At current levels, the bank's model assesses the rand to be somewhat overvalued, and further strengthening potential is probably limited. The rand has reacted positively to domestic political developments in the past months and was given further support following the recent sovereign credit rating announcement. The risk of a significant sell-off of South African government bonds by non-residents has therefore receded for now. Further support for the rand comes from recent dollar weakness. Some widening of the current account deficit is expected over the forecast period as imports increase in line with higher expected investment expenditure and the impact of a stronger rand. A key external risk to the rand remains the possibility of a tighter than expected stance of monetary policy in the US in particular. As anticipated, a moderately faster pace of tightening was signaled by the US FOMC, particularly for 2019. And at this stage, further tightening is expected to remain measured in the absence of significant inflation or growth surprises. Significantly higher US fiscal deficits could also elicit a stronger monetary policy response. The pace of monetary policy normalization in some of the other advanced economies continues to be gradual with a tightening bias. The domestic economic growth outlook for this year is more favorable but remains challenging. This follows an upward revision of historical GDP data and a fourth quarter outcome of 3.1%, which surprised on the upside. Following an annual growth rate of 1.3% in 2017, the bank expects a growth rate of 1.7% for 2018 compared with 1.4% previously. The forecast for GDP for 2019 is 1.5%, marginally lower than the previous forecast of 1.6%, while a growth rate of 2% is forecast for 2020. At these growth rates, the negative output gap, which measured 1.1% in 2017, is expected to close in 2020. The composite leading business indicator continued its upward trend in January, consistent with the improved outlook. The improved growth outlook is driven primarily by an increase in business and consumer confidence. This is reflected in the RMB BER Business Confidence Index, which increased markedly in the first quarter of 2018, although it remains below the neutral 50 level. Furthermore, the expected business conditions category in the ABSA PMI surged in February to its highest level since 2001. In this context, growth in gross fixed capital formation is forecast to increase gradually over the forecast period. Consumption expenditure by households is also expected to be positively impacted by the expected increase in consumer confidence, although this is not yet evident in the consumer confidence survey. In the near term, consumption expenditure is expected to be constrained by the tax increases, the lack of compensation for fiscal drag, weak employment growth, as well as by subdued growth in credit extension to households. While consumption expenditure is expected to grow at a slightly slower rate in 2018 compared with last year, the trend over the forecast period is moderately stronger than previously expected, reaching 2.1% in 2020. This improvement is also supported by higher expected wealth growth over the long term. Employment trends remain a concern despite an increase of 102,000 jobs during the past year. The official unemployment rate was slightly higher when compared to the same quarter in 2018, while the number of discouraged job seekers increased markedly. The national budget presented in February 2018 proposed a faster pace of fiscal consolidation than that indicated in the October MTBPS. This revised path is expected to result in a stabilization of the ratio of government debt to GDP at about 56% over the medium term. The moderately tighter stance is due to an overall cut in budgeted expenditure growth, as well as an increase in tax revenues. However, the projected deficits are wider than those proposed in the February 2017 budget. The outcome of the ongoing public sector wage negotiations will be an important indicator of the sustainability of the fiscal projections and future wage trends. Nominal wage growth appears to be moderating slightly, but upside pressure on inflation from this source is expected to persist. Average wage inflation is expected to decline moderately over the forecast period from 7.6% in 2017 to 6.8% in 2020. Still positive in real terms. Annual food price inflation is no longer seen as a major risk to the inflation outlook. While the continued drought in the Western Cape is likely to adversely affect agricultural production in the region, the direct impact on food prices is expected to be fairly limited. The MPC noted the general improvement in the inflation outcomes and the lower inflation expectations. Although the bottom of the inflation cycle has likely been reached, the trajectory of headline inflation is forecast to remain within the target range, with core inflation expected to remain below 5% for most of the forecast period. To the extent that inflation expectations are adaptive, there may be further downward adjustments in these expectations in the coming quarters. As mentioned earlier, the MPC would prefer to see inflation expectations anchored closer to the midpoint of the target band. In considering the impact of the VAT increase, the approach of the MPC is to look through the first round effects of this increase and focus on the second round effects, which are expected to be relatively small. In any event, the policy horizon of the committee extends beyond the period during which the first round effects have an impact. The committee assesses the risks to the inflation forecast to be more or less evenly balanced. Some of the key domestic risks and uncertainties that overshadowed the outlook in recent meetings have abated. The government budget was generally well received, but implementation risks remain. While the recent sovereign ratings outcome was positive for the rand, further sustained appreciation of the currency is not expected. The exchange rate is currently assessed to be less of a risk to the inflation outlook. However, the rand will remain sensitive to a faster pace of normalization in the advanced economies, possible heightened global financial market volatility, as well as domestic developments. Although the growth forecast has improved, the outlook remains relatively constrained. Despite the higher levels of consumption expenditure in the latter part of 2017, demand pressures in the economy are not assessed to pose a risk to the inflation outlook. The MPC assesses the risks to the growth forecast to be moderately on the upside. To make an appreciable impact on employment and potential output, the current improved levels of confidence will need to be sustained and translate into higher levels of investment. This can only be achieved through a firm commitment to an implementation of credible structural reforms by government. The MPC was of the view that in the light of the improved inflation outlook and the moderation in the risks to the forecast, there was some room to provide further accommodation without undermining the inflation trajectory or the downward trend in inflation expectations. Accordingly, the MPC decided to reduce the repurchase rate by 25 basis points to 6.5% with effect from 29 March 2018. 4 members preferred a reduction, while 3 members preferred an unchanged stance. In this uncertain environment, future policy decisions will be highly data dependent and sensitive to the assessment of the balance of risks to the outlook. The implied path of policy rates generated by the QPM model has changed since the previous meeting. Whereas previously 2 to 3 increases of 25 basis points each by the end of 2019 were indicated, 1 increase of 25 basis points is now implied. 2 further increases are indicated in 2020. As emphasized previously, the implied path remains a broad policy guide which can and does change in either direction between meetings in response to new developments and changing risks. Therefore, the MPC does not mechanistically respond to changes in the path. That concludes the statement, and at this stage, let us take whatever questions you might have. And as usual, please identify yourself and the name of the media house that you represent. Ma'am.
Good afternoon, Governor and everyone. This is Amakhalang Bata for Bloomberg News. I just wanted to ask if a 50 basis point cut was discussed, and if so, why the MPC did not opt to go that route. Also, just adding on to that, did the VAT increase, and possibly, not knowing how much longer the rand can sustain its current levels, impact that decision to rather opt for 25 instead of 50 basis points?
The last bit of your question, I'm not sure.
Did the VAT increase and possibly the rand strength play into why the MPC decided against a 50 basis point cut if it was discussed at all?
Okay, that makes it very easy. Ma'am, in front.
Thank you, Governor. It's Mariam Issa from Finweek. Two questions quickly. You didn't mention, the statement didn't mention anything about the public wage negotiations. Is this an inflation risk in your view? And what would be the upper end of the increase that you would consider to be inflationary? Second question, you've reduced your growth forecast for next year, which I wondered why. And also, there's a big jump between next year and 2020 of 0.5 percentage point. And I was wondering why you see such a big increase over this period. Thank you.
One more? Is that it? Oh, that's relatively easy. There's nothing on the online there? Nothing. Okay, eventually. Ma'am.
Sir, Hilary Jaffe from Business Day. Your growth forecasts, now revised, are lower than some others, for example, Standard & Poor's, which has been quite bullish on growth, and even for one of the years, the Treasuries. I wondered what you see as being the risks to growth and why they are relatively low compared to some in the market. Thanks.
Yes, ma'am. Oh, there's a real human being here.
Thank you. Thanks. Hi, thank you, Governor. Cole Ganetsky from Business Live. You didn't mention anything on the outlook for the fuel price. Has there been any changes there? Thanks.
Okay, yes.
Razia Khan, what conditions would make the MPC ease further given forecast CPI trajectory?
Okay, thank you very much. Amakhalang, there was no discussion of a 50 basis point cut. It was either a hold or it was a 25 basis point cut. And as you can see from the preferences of the MPC members, it was a very heated debate, and so hence such a close call, and eventually we came to an agreement, and the agreement was that the appropriate stance would be to relax policy by 25 basis points. VAT and the exchange rate, they played in the opposite direction. So whereas VAT, as we had indicated, would lead to inflation being 0.6% higher than what it would have otherwise had been. So to be clear, the forecast that we have has already built in the VAT increase. So the forecast that we have tabled already includes the VAT increase and what we expect to be the second round effects from that VAT increase. The exchange rate, because it had been stronger, if you remember at our previous meeting, we had the exchange rate assumption at 12 rands 90. What the strength of the exchange rate did was to partially offset the inflationary effects of value-added tax. But once again, value-added tax, you do not have this increase every year. This is the first increase we are having since the last announcement in 1991, right? So, 27 years ago that we last had a VAT increase. So it will get out of the system by the end of March next year, and inflation would normalize. What had benefited us this time around had been the fact that the exchange rate had strengthened and has taken these things off. And maybe ditto for what you were asking about the fuel price, that we had seen, that we had had decreases in the fuel price at the pump. Yes, we didn't talk about it here, but I will leave Rashad to find a figure for you of what the current over or under recovery is. Probably an over recovery. And Miriam, we specifically refer to the public sector wage negotiations in the statement. We say that they could actually pose a threat to the fiscal stance, and it becomes important not just for the fiscal stance. It becomes important because the public sector wage settlements actually do have an impact on the settlements that the other sectors eventually agree to. The growth forecast, our growth forecast is less than what you had seen the others having stated. Look, there are a lot of unknowns, and you asked where we see the risks. With respect to growth, we are very clear that the risk to the growth outlook are on the upside. So if there are any surprises from growth, we expect that they would be on the upside. So yes, we have gone with this growth rate. You say that it is less than many other forecasts out there, but we see the risks to that growth to be on the upside. The jump in 2020, is perfect vision. 2020 is so far out. It gives us a lot of degrees of freedom, but we actually expect that if the current positive confidence is sustained, if the reform agenda of government is implemented and followed through, and if the sentiment is followed by investments, and if the current consumer confidence feeds through into consumption expenditure, we expect that these things will be driving growth. There is also the important thing that the global growth environment is actually more favorable. And as a small open economy, we do benefit from a resurgence in global growth. And any analysts today will say to you that global growth could be sustained at these levels for some time.
Right, and that is Reserve Bank Governor Lesetja Kganyago giving a little gift to indebted consumers. The interest rate coming down by 25 basis points. That looks like 0.25%, but slightly different. What this means is that the repo rate at which the bank lends out to commercial banks, that's gone down to 6.5%. But for most people, the important figure, 10%, the prime lending rate, and that could affect you if you have a mortgage bond. If you're paying off a car, it means your payments could come down a little bit. For many people, it won't be significant, but if you're in a tight situation, that could make a difference, and depending on how indebted you are. And this is all about inflation. Remember, the bank uses interest rates to control inflation. If the rate at which goods prices are rising is too quick or is seen to be too hot, then it raises interest rates. That makes it a little bit more difficult for you to go out and borrow and go to the stores and spend. And basically, the more people spending, the faster those rates are rising. But it looks like inflation is well within the target of between 3% and 6%. And that's despite the VAT increase. I thought it was very...
The spot price of Brent crude is higher than that. It's closer to 70, but we expect it to moderate during the course of the year. In terms of the short-term petrol price increases, we expect for in April what we are expecting, and we know will come through, are the fuel levy and the road accident fund, which would be approximately 51 cents per litre, I think, and then currently the under recovery on the fuel price is about 10 cents a litre. So in the region of about 60 cents, but there could be additional adjustments that are made by the department.
You want to ask a question? Okay, go ahead.
Maybe just to comment also on Miriam's question about the lower growth in 2019. Bear in mind that both 2017 and 2018 was revised. Particularly 2018 was revised from 1.4 to 1.7, so there's an element of base effects in 2019 that you should also bear in mind. And by the way, the reduction was very marginal from 1.6 to 1.5, but base effects would have had an impact on that number as well.
Let's reverse the order now and start with Hilary and then come to Miriam.
Governor, may we welcome Dr. Chazibana to the MPC. I think this press corps has for ages been asking you when you were going to appoint a 7th member, and also when you would include a woman in the MPC, and we do welcome you. And I do have a question as well, which is, could you give us a sense of what was the chief concern of the 3 members who voted against a rate cut? Thanks.
Miriam?
Okay, back to the inflation and wage increase issue. You've made predictions about the average wage inflation expected going up to 2020, which is 6.8%, down from 7.6% last year. Given that you've come up with this forecast and public wages are part of it, could you tell us your assumption for the public wage increase there?
We don't have any.
You don't have any, although it's a big part of average wage increases. Okay.
It's in there.
Sorry?
It's in there.
Okay. Then coming back to the implied path of policy rates, yeah, I'm probably missing something here, but it's pointing to a couple of one interest rate increase next year, and 2 further increases in 2020. And even though this is just a broad policy guide that can change direction, I don't really understand how you can cut rates when this is pointing to rate hikes.
Okay. Hilary, I think you should take my job. I was going to welcome Ms. Chazibana at the end of the thing, but thank you very much for that welcome. She just sent me a note to say, please remind Hilary I'm not a doctor. Hilary, you know, one of the things that unless that you will never figure out, the day you figure it out, that means the MPC has collapsed, is to try and figure out who preferred what. The day you figure it out, we will disband the MPC. You will not be able to find it out. So let's get to the thing. The statement as it is spelled out, and where we spell out the risks, even to the inflation, and we say they are fairly evenly balanced, reflect the collective view of this MPC. So all of the MPC members see all of these risks. The thing that you would have within the MPC would be the likelihood of the risks materializing, and that is where judgment comes in, and it's on that basis. So what do you see as the case why we had a further accommodation provided, and what you also see here as being the risk of doing so, which then spells out that we think this thing can be done without undermining the current trajectory of inflation expectations going down, reflects what this entire committee holds, irrespective of the views that everybody held coming into the meeting. It's interesting that you didn't ask the views of the other three who wanted a hike. The point here that I'm making is every MPC meeting, every decision is still a decision. Even if the MPC came out with a no change in stance, it is still a decision. That does not mean that we didn't crack our heads trying to figure it out. We did that. So that deals with your 4.3. Miriam, you are confused by the path. And I'm so glad you said 2019, because we are not in 2019. The model says that it's expected the first cut in 2019. We are in 2018, so understand that. Understand that. But can I put it this way, Miriam, and say that the model is a tool that we use. And in a way, the forecast that comes out gives us a rough estimate of what the future could look like. So it's almost like a weather forecaster who tells you there would be drought or there would be rain and so forth. What a policy maker would do when they hear there's going to be a rain or a drought is to decide, do I store extra food now, or do I plant more this year so that when the drought comes, I have got the extra food? And in a way, in determining policy, you assess these risks to inflation and to growth, and you have to make a judgment about those risks. And amongst the tools you use in arriving, the inputs that you use to arrive at the judgment would be a forecast. And a forecast could have said to you, we suggest you plant more this year because there is drought coming, so that you could have excess stock, so that when the drought sets in, you can dip into your stock. That does not necessarily mean there is going to be a drought. They might turn out to be rain, in which case you have got the extra stock. That seems to be a good problem to have, because you can always sell the extra stock. But if you didn't store it and you end up with a drought, then you have got all sorts of problems. And in a way, in deciding the monetary policy stance using the QPM and all these other factors, we consider that weather forecast. And based on that weather forecast, we make a judgment. So in this case, instead of rain and drought, we will have what will the output gap look like? What would the inflation deviation from the target look like? What would the exchange rate gap look like? And what would the interest rate gap look like? And what this model then tells you is that you have got these potential gaps that could materialize in this manner over the forecast period. And you, as the MPC, have got to then make your judgment about whether those risks materialize or do not materialize, and based on that, you determine the appropriate monetary policy stance. Is that clear? Thank you. Yes, ma'am.
This one is from Stanislav Petrov. Could you please explain the SAB's assessment of the current neutral real rate and how that has been affected by the recent fiscal policy changes?
It is from who?
Stanislav Petrov.
From where?
He doesn't say.
And, well, we said everybody must identify themselves and the organizations where they come from. I guess I do not want to entertain that lest I set a dangerous precedent, but unless there was a question like that in here. Any other questions? That's the last one. I hope you, oh, you want to ask the same question? Okay, you are the last.
This is a little bit historic, but I just wondered, when was the output gap last closed?
When was the last?
Well, you're predicting in the statement that it should be closed by 2020, and I just wondered when it was last.
Yes, when we were doing very well, it didn't just close, it opened on the other side, and it became positive, and it is in the period between 2004 and 2006 about, up to 2008 about. The thing about these things is that these are not observable variables. So sometimes it turns out later on that when you look back that, oh, it looks like that output gap was closed or it was wider. Unfortunately, it is a question of judgment. I guess the question is when it closed, what did you do about it? And of course, when it closed, other things happened. Okay, that concludes the business of today. Thank you very much. We will see you in May.